2018 was definitely a very interesting year, not like what we've seen in the last few years. We started off very strong, then had a bit of a pullback in Q1. Then the markets kind of got back on track and we started to head higher again. But when we got to Q4, volatility really picked up and we saw the markets really have a big pullback. So as we ended off the year, we were really in quite a negative tone. When we think about the different geographies within the equity markets, US in particular was probably one of the stronger from an economic standpoint, but even despite the fact that it was firing on all cylinders, it still couldn't have a positive return. Emerging markets, on the other hand, were negative all through the year because of all the tension going on with trade discussions between US and China. So as we look out, going forward, you think about all those things that are still, uncertain, those are still going to have impacts to 2019. Where do I start? The first thing obviously is trade across the world. We saw some resolution amongst other markets, but when it comes to US and China, those are still quite severe. We haven't seen, the clarity there quite yet. We have seen some positive movements, but this is something that probably will take some time and has gotten markets to really be quite volatile. As we know, people don't like uncertainty, and uncertainty causes volatility, and this is probably the biggest uncertainty out there. The second one is interest rates. Where do interest rates go in 2019? We just came through the Fed meeting in December, and though what the Fed said was expected in terms of bringing down the forecast on interest rate hikes in 2019, the way they said it was not the way the market liked. And therefore we saw a major pullback in the equity markets right after that Fed announcement. So clarity on interest rates will be very important, and without that we will see again more uncertainty and more volatility in the markets. And the third is, we've had a very strong bull market, almost 10 years now. People get nervous when we've been doing so well for so long, and so they're just expecting to see a pullback, and that sometimes causes the markets to actually reverse, and maybe that's part of what we're seeing today in terms of the added volatility. Well, stocks have done exceptionally well over the last few years, but in Q4 they definitely had a severe, sharp decline. Now, part of that was tied to the fact that we're starting to see earnings numbers slow down a little bit. Growth companies can have excessive growth, and then they have moderate growth. And so we're seeing some of that in some of these technology companies. But the other thing that worried a lot of investors was the fact that what we were seeing was a cautious outlook going forward. And so maybe the earnings going forward won't be as strong as what we've seen so far. The other thing that's added a lot of uncertainty to technology stocks is what's going on with data and privacy issues. And we've seen that particularly impact Facebook stock, which has dropped more than 40%. These are the type of things that may add additional costs and therefore bring down margins in some of these companies. And the last thing is, as technology continues to evolve, we're seeing regulation potentially pop up. And if we add more regulation to that sector, again, we'll add more costs and reduce our growth trajectory on some of these names. So therefore, probably you're going to see prices come off like we're seeing so far in 2018. Well, Canadian oil is first measured by WCS, and US oil is measured by WTI. What we saw this year was a divergence at times of almost $50 a barrel. Now, normally that divergence is about between $10 to $15. But this year what you'd see is there's a few reasons why we've seen that divergence pick up. One definitely is the fact that we have lack of pipeline capacity. Number two, the fact that despite the lack of pipeline capacity, we're still overproducing our oil. So more supply than is actually needed. And that's obviously caused oil prices to come down. The third is because we don't have the capacity on the pipeline side, we have to transport that oil in more expensive ways. And that's added about $10 a barrel to our cost. And then if we think about some other temporary factors, we've also seen that when we send our oil to the US refineries, some of them have been in maintenance mode. So they don't really need all that supply, and therefore we've getting this oversupply versus demand situation that's going on. Now, Alberta has responded to that by cutting back supply to try to bring that gap down, and that has caused a divergence between Canadian oil and US to come down a little bit as well. I expect as we go into 2019, we're going to see more of that, and therefore the divergence becomes smaller and smaller.